Good afternoon once again, and thank you for joining us today for our webinar on financial reporting during COVID-19. My name is Mary and I'll be your moderator today. If you have any questions throughout the webinar, feel free to message in the chat box. To open this, you can click on the chat icon at the bottom of your screen and it will open the chat box. If you have any technical difficulties, feel free to message me by clicking on the drop-down menu and selecting all panelists, and then it will message me directly. We'll open the floor to questions at the end of the presentation, but we encourage you to ask questions as we go along. You can also use the raise hand if you have any technical difficulties. If your presentation screen happens to be too small, you can click on the line and drag it to the right, and it will then look like this. Today, our presenters are financial experts Nicole Buchek and Eric Gross. So without further ado, I will pass it over to them. Good afternoon.
Good afternoon. Good afternoon, everybody. Thank you for joining us today. Before we get started, I do want to take a quick poll to see the roles of those that are joining us today, so we know who we're discussing with. Everyone can take a quick moment to answer a quick question for us. Give it another minute or so. Great. And we have a variety of people here with us, so that's great. Okay, so earlier this year, when the World Health Organization announced a public health emergency, our world returned upside down, and companies have had to face cash flow management questions. They've had to face government regulations and supply chain issues. But one of the important considerations that we need to work through is also financial reporting and how that's going to impact your financial statements, especially if you're reporting to lenders with assurance engagements, which would be a review or an audit engagement. So we can switch over to the agenda. Some of the items that we're going to go through today are crucial for this analysis, and it's important to look at this early so you can be productive and proactive with your lenders if there are any issues and concerns to plan and respond appropriately. I would like to note that today's presentation is primarily based on accounting standards for private enterprises, or ASPE. If your organization does follow international financial reporting standards or accounting standards for not-for-profit organizations, please do reach out to us, as we will have custom guidelines that may apply to you that may not be covered here today. So one of the first topics we are going to cover today relates to asset impairment. This is important to look at in terms of, for example, have your portfolio investments experience significant market decline? Have other investments experienced significant market decline? What do your accounts receivable look like? Do you have significant customer contracts that have been canceled? Goodwill and intangible assets such as customer lists, has there been any write down in terms of value that you need to look at and disclose? Then we'll go into things like going concern and subsequent events and covenant violations, where you have to look at considerations such as, have you had to close or significantly reduce operations? What's the operations of your organization going to look at over the next 12 months? And what does that mean in terms of disclosure and how to account for that? What's been the impact of employee layoffs or a decrease in customer demand? Significant disruption in production or supply, and all those reductions in operations and impacts, has that led to a covenant violation in your lending agreement that needs to be addressed? Then we'll briefly touch on some impacts to audit testing. There's a lot of topics in that category that could be covered, but for today we're going to focus on inventory accounts, and then we'll move into accounting for some of the government subsidies. So I will pass this off to my colleague, Eric Gross, to get us started.
Okay, perfect. Thanks, Nicole. So the first thing we're going to talk about in terms of asset impairment is just on the portfolio investments. So large amount of companies have invested their extra cash in portfolios with different banks, which are invested in the stock market. With COVID and the pandemic that occurred, it's really affected the world markets. and it might turn out that the fair market value of those investments is actually below what you originally paid. So there is some financial reporting impact from that. So per ASPE, the portfolio investments must be recorded at the lower of their cost and their fair market value. These two amounts are usually located on the investment statements that you'll receive. So you'll have the amount you originally paid, and then whatever the fair market value of those investments is. With COVID, it might turn out that the fair market value is actually decreased below the amount you originally paid, and a write-down may be necessary. So if written down, the loss would be included in your other income and expenses for financial statement presentation. So that would show up outside of your regular revenue. It is also important to note that if the portfolio investments would increase above the value in the future, that loss can be reversed back up to the original value. So for instance, if you have shares in, say, Coca-Cola Company, you bought them at $100. Due to COVID this year, at year end, the share price has gone down to 75. Depending on the materiality of your assurance engagement, which you'd need to discuss with your accountant. If a loss was recorded, the $25 difference, you would have to record the impairment loss. And then in the future, if the price increased to, say, $125 per share, then you could write up the cost of that asset back up to the original $100 investment, and experience those gains if the share price remained that high in the future. In terms of investment in subsidiaries is another important area to look at in terms of whether there's an impairment there. So per ASPE, a subsidiary is an enterprise controlled by another enterprise, and that other enterprise is typically referred to as the parent. And that parent has the right and ability to obtain future economic benefits and is exposed to the related risks of that enterprise. Basically, the parent controls the subsidiary and can dictate how that company earns income and the different decisions that are made on a day-to-day basis for that company. This is typically seen in a holdco-opco scenario where the owner holds all the shares of the holdco and then the holdco owns all the shares of the operating company. So in ASPE, the parent can consolidate the subsidiaries. There are three options. So they can consolidate. They use the cost method or the equity method. I won't go into too much detail on those, but those are the options. And it's also important to note that ASPE says that at the end of each reporting period, otherwise referred to as a year end, the parent shall assess whether any of its investments in subsidiaries are impaired. So there are various indicators of impairment, which can include the subsidiary entering into financial difficulty. It is either in financial difficulty or it's probable that it will enter financial difficulty. And we just look at the next slide quick. And then there's also, if there was a change in market making the subsidiary's products obsolete, that would also lead to a decrease in value of the investment in the subsidiary, which would decrease it below the original cost that you paid for it. This list isn't exhaustive. It's just a couple examples. So it's kind of almost a gut feeling of how the subsidiary is responding in the pandemic times, whether it's having cash flow issues, whether there's any issues with it being able to pay its vendors or anything like that, or going towards bankruptcy. There might be an impairment loss to record there. Next slide. So when the parent identifies an indicator of impairment, it will reduce the carrying value of the investment to the higher of the following. So you'll do a calculation either of the present value of the cash flows expected to be generated by holding that investment, discounted using a current market interest rate appropriate to that asset. So this could be the average lending rate that your company can acquire or can get from a bank. It kind of just depends on whatever the asset is. The other amount to compare it to is the amount that could be realized by selling the asset at the balance sheet date. So this is otherwise referred to as its fair value. And this is if you were to sell the asset to a complete third party, you don't know them at all, and it's basically a market transaction. And then again, if applicable, then an impairment loss would be recorded for the difference between the fair value and the carrying value. And again, that's dependent upon what the materiality is for your specific assurance engagement. It might show up on a schedule of unadjusted differences or something similar to that, and not be an entry that's actually recorded, but should be noted for the future. The next thing to look at in terms of impairments is just your accounts receivable and related party receivables. Per ASPE, the balance of accounts receivable and related party receivables should be assessed for their collectability. At a minimum, ASPE says to do it at the end of every reporting period. We suggest doing it a little more often than that to make sure you're actually collecting on the cash for the revenue that you're recording. For receivables, an allowance for doubtful accounts would be set up. It would be, and to record this, it would just be a credit to allowance for doubtful accounts and a debit to bad debts expense. And it's important to note that when a receivable is in allowance for doubtful accounts, you are still trying to collect, and you're making every effort to obtain those funds. So in the pandemic times, some companies having cash flow issues may not be able to pay all their vendors, so you'll need to critically assess whether your customers are going to actually be able to pay you the money that they owe you. And if it's doubtful, you would put it in allowance for doubtful accounts. However, if the receivable does become uncollectible and you're no longer trying to collect it, like the customer goes into bankruptcy and there's no way you're going to be receiving that money, it should then at that point be written off. So it'd be a credit to accounts receivable, and then you would debit the allowance for doubtful accounts to completely remove it from the books. And previously you would have recorded the expense for that through the bad debts expense. It is also important to note that the bad debts expense can be reversed if the amount is collected. So if you put an accounts receivable into allowance for doubtful accounts, and then later the customer turns it around and suddenly pays you back, well, then you can debit the allowance and credit the bad debts expense, and then it would be a recovery on the income statement. I can go to the next slide. So the next thing to kind of consider is asset impairment as it relates to your goodwill and intangible assets. So just to give a quick definition of what goodwill is. So goodwill is the asset representing the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So for some companies where they acquire another company, as a quick example, they pay $1 million. Turns out that the assets of that company are worth, say, $900,000. That $100,000 difference that you overpaid is considered goodwill. And that could be for any number of things like the employee's knowledge or a customer list, something similar to that. And that's what's generating that extra goodwill value. So again, ASPE says that goodwill should be tested for impairment whenever events or changes in circumstances indicate that the carrying amount of the reporting unit exceeds its fair value. So whenever those indicators of impairment that I mentioned before, if any of those pop up, that would be a scenario where you might need to reevaluate whether your goodwill that you've recorded on the books is actually worth what it's worth, or it's worth less than that because its fair value has declined. So when an impairment exists, the impairment loss equal to the excess of the carrying value over the fair value should be recognized. And the impairment loss cannot exceed the carrying value. And it can be, and again, this is another scenario where it can be reversed if the fair value subsequently increases. And then ASPE also states that for each impairment loss that you would record in your books, the following should be recorded in the statement. So you'll need to describe the impaired intangible asset or goodwill, and all the facts and circumstances that led to that impairment. You'll also need to state what the amount of the actual impairment loss was. And if it's not blatantly, if it doesn't blatantly appear on the income statement, you'll also need to show where the loss or what line the loss is recorded in, just to make it super clear for any lenders or any users of the financial statements. So just in general for asset impairment, typically at each year end, you'll need to assess the following questions. COVID might have changed your answer to some or all of these questions. So the first one is just whether you're going to actually collect all the receivables outstanding in your books. So if the customers can't pay you, whether you should be setting up an allowance for doubtful accounts or just writing off the accounts receivable altogether. The second question is just, have the investments you have made deteriorated in value? So in terms of your portfolio of investments, whether it's gone down due to the pandemic below what you originally paid for, there might be an impairment loss to record there as well. Same with your investments in your subsidiaries. And then just in general, something to consider is that, are your assets actually going to deliver more economic benefit than their original cost? So basically, is the value that the asset is recorded at, am I actually going to receive that in the future, or is it actually an amount that's less than what I originally paid for it? So as mentioned, COVID-19 has caused many cash flow issues in industries and caused the deterioration of the world markets, and it may affect your answers to these questions. I'll now turn it over to Nicole to go through going concern.
Hey everyone, before we get started on this next topic, I do want to run a quick poll just to see what's concerning everyone the most. We are curious about what you're thinking about. So given everything that's going on, are you not even thinking about your financial reporting? Are there specific aspects of your financial reporting that are bothering you and concerning you the most? Give it another minute or so. Okay. Interesting. So the highest number of concern at the moment is the lender's reaction to additional note disclosures. When we were originally talking about this presentation, that's not where we thought the concerns were going to be. So this is very interesting. What I'll do is I'll get started on going concern, and at the end of the presentation, if there's any specific questions around that in particular, please do raise it in the Q&A. So one of the requirements under accounting standards for private enterprises is that financial statements are to be prepared on a going concern basis, which just means that as a company or organization, you can meet all your commitments and continue operating for a 12-month period. Unless management intends to liquidate the company, cease trading, or has no realistic alternative but to do so. When performing this analysis on whether you can continue as a going concern, you have to do an analysis of the events that occur between your year-end date and the date of the completion of the financial statements, which would be the management approval date. Or you also have to do analysis on the uncertainty of the effects of COVID-19. So in terms of everything COVID-19 has done in terms of reduction in operations, et cetera, what does this mean for your organization going forward and your ability to continue operating? When this assessment is performed, management has to decide if there's material uncertainty in whether you can continue as a going concern. So when you're in discussions with your accountant or auditor and you decide that really you're just not sure, we're not sure what the next year is going to bring, and we're not sure if we'll be able to continue operating and meet all our obligations, then under ASPE that has to be disclosed. Whether or not there's a significant doubt on the ability to continue as a going concern is very, very company specific. Therefore, it's important to be proactive with those discussions with your accountant and auditor early so that assessment can be made, and discussions about what that note disclosure might look like can also happen early. Next slide, please. If it's decided that a material uncertainty does exist, so you've had these discussions amongst management, you've had these discussions with your accountants and auditors, the auditor or accountant is required to draw attention to this material uncertainty with a note in the financial statements, as well as a note in the audit or review engagement report. In the audit or review engagement report, drawing attention to the going concern disclosure in the financial statements does not mean that there's a modification of opinion. You can still have a clean opinion. All it's doing is drawing attention for the user that there's a material uncertainty, and here's where you go to learn more about that uncertainty. However, if the assessment's made that there's a material uncertainty about the ability to continue as a going concern, and the decision is made not to disclose it in the financial statements, then your auditor or accountant may need to express a qualified or adverse opinion on your review or audit report. I've included a couple of examples here for your reference. The first example is for an audit report where a going concern issue exists, and that has been disclosed in the statements. So this is just drawing attention to the note in the statements where the user can go to learn more about the issue. And it specifically says that the opinion is not modified because of this going concern issue. It's just drawing attention to the note. In the second example at the bottom, what this is doing is showing that there's a material uncertainty. Management has decided not to disclose this in the notes to the financial statements. Therefore, the auditor has issued a qualified opinion because the financial statements do not adequately disclose a material uncertainty around going concern. The next topic I would like to cover is subsequent events. So really there's two types of subsequent events. The first one is an event that provides evidence of conditions that already existed at your financial statement date. And the second one is conditions that arose subsequent to your financial statement date. Depending on the year-end date of the company, analysis needs to be performed as to whether COVID-19 provides any evidence relating to conditions existing at the financial statement date. In accordance with ASPE, if an event is discovered subsequent to your financial statement date, but it's discovered that that doesn't indicate any conditions that existed at your financial statement date, this has to be disclosed. It has to be disclosed if it causes significant changes to assets or liabilities in the subsequent period. So a COVID-19 specific example would be if you have a portfolio of investments and subsequent to year end, because of the impacts of COVID, the market value of those investments deteriorated. The second one is a significant impact on future operations of the enterprise. This is the most common one we've seen because really everyone is uncertain in terms of what the next 12 months is going to bring for operations. So if any of the above conditions are met, a disclosure is required for a subsequent event, describing the nature of the event, as well as an estimate of the financial impact. And if that estimate can't be made, either a statement that the estimate can't be made or a potential range, and trying to disclose the likely impact on the entity and its significance. So on the next slide, I've included a couple examples. This first example is in relation to the first example I mentioned, which is the asset decline. So I won't read through this entire example, but what this does outline is a subsequent event disclosure where markets have declined, investment values have declined, but no fair value adjustment has been made because management has assessed this as temporary. And on the next slide, this is real. Oh, if you scroll back one. This disclosure is around the disruption of operations. This has been the most common one that we've seen. It's tailored depending on company specific circumstances, but really what this is saying is we don't know what's going to happen because of COVID. We don't know what the disruption of services is going to be and what this is going to mean for operations going forward. Next slide covers covenant violations. So COVID-19 and the disruption on operations and all those things we've been talking about may result in breaches of your debt covenants or could result in covenant clauses being triggered. This could mean that your company's debt becomes payable on demand or before the maturity date, and it could also impact how that debt is reported on your balance sheet. It's important to do an assessment on where your covenants are early so that you have time to start the renegotiation discussions with your lenders. If you estimate that your covenants are going to be breached, you can assess whether you can obtain a waiver or a grace period from your lender, or whether a full renegotiation of the covenant clauses can be performed. If you do this assessment and you see that your covenants are violated, there are some disclosures that are required in your statements. You would have to disclose whether any financial liabilities were in default or breach, and then you have to disclose whether that default was remedied. If there is a covenant violation and there's not a waiver or there's not a grace period that has been given, then you are required to classify that entire long-term liability as a current liability. The final topic I'd like to talk to you about is audit testing, specifically around inventory accounts. One of the questions we received quite a bit is, I don't have staff, how am I supposed to get anyone in the door to do inventory accounts for my year end? If that applies to you, you do have a couple options. Option one is staff an inventory account as soon as possible, have the auditor attend, and the auditor can perform rollback procedures back to your year-end date. So there's alternative procedures that can be performed. If a count cannot be performed, the auditor can attend, or there's no alternate procedures that can be performed for that inventory account, then a modified opinion may need to be issued. I've included an example for your reference in the next slide. I won't go through all of this, but the webinar is being recorded, so you can come back to the slide for your reference later on in terms of what this qualified opinion may look like. What I'd like to draw attention to here is if you are in a situation where you may need a qualified opinion because you are not able to have an inventory count, again, have that discussion with your lender early so you can talk about what the impact is and what they may be looking for from you. And I will pass this off to Eric. I believe we have one more poll.
Yeah, so this poll just kind of goes through any of the assistance programs provided by the government. Just kind of want to see what you've signed up for, if any, and what we should maybe draw a little more attention to. So that's kind of what we expected. A lot of people have signed up for the emergency wage subsidies. So we'll just touch on those next. So just in terms of how to account for these subsidies, like it's great that you've got them and signed up for them, but then it comes to actually recording them in your financial statements. So for the 10% and 75% wage subsidies, they're both actually just recorded as other income. So it would be a debit to cash and credit to other income. And that's how it'll show up on your financial statement. So it's not super complicated, but it does need to be put in that other income because it's outside of the norm. In terms of the Canadian Emergency Business Account, so this is a loan up to $40,000. You have to meet certain eligibility requirements, like you paid so much in salary last year, or dividends per the update. And then with 25% of that loan actually being forgivable if the balance is repaid by December 31st, 2022. So under ASPE, the loan is actually considered a forgivable loan and should be set up as follows. So quick example is if you borrow the full $40,000, 75% of that amount, so $30,000, will be set up as a loan payable, and the other 25% will be set up as other income / government assistance income on the income statement. So in that case, it would be $10,000. And then in the future, if you fail to repay the 75% by December 31st, 2022, the 25% portion, so that $10,000, will be moved into a loan payable account at that time. So it would just be a debit to government assistance income and a credit to the loan payable, and then you would pay off that loan over the next year. The last one just wanted to touch on is the emergency commercial rent assistance. So again, this is another forgivable loan, and it covers 50% of eligible small businesses rent from April to July, and there is an August extension coming soon. So if you're the property owner, you kind of treat this the exact same way as you would treat the CEBA loan. So the forgivable portion would be set up as government assistance income. And then if you are a small business tenant, the reduction in rent will be recorded as if it was a tenant inducement and amortized over the length of the remaining lease agreement. So for those of you that aren't sure what a tenant inducement is, it's just, for example, a landowner gives you 2 months rent free. You don't, per ASPE, you just don't record rent for those 2 periods. You would take the total rent paid for the full agreement and amortize it over the number of months in that agreement. So it works similarly for receiving some government assistance. You would again amortize that reduction over the remaining lease term and record the rent expense that way. So now I'll give it back to Mary to see if there's any questions.
Thank you, Nicole and Eric. We'll now be moving into our question period. If you have any questions, feel free to put them in the chat or the Q&A box.
Okay. If there are no questions, Mary, do we want to move into how they can contact us for further questions?
Yeah, we can. So this is our 4th session of the summer webinar series, and we have one more session, which is bookkeeping in a virtual world. If you'd like to register, you can go to rlb.ca/events. Actually, we do have one question coming in right now. Because of minimal staff, we couldn't separate duties like we normally would. So how would we approach that at the end of the year?
So if there's been an interruption in control procedures because of staff interruptions, then you have 2 options. Your auditor could decide to go to a substantive approach. So for this particular year, they're not going to rely on controls. The alternate approach is that period where you didn't have segregation of duties can be isolated, and substantive testing can be performed for that period where the controls didn't exist, and controls can be performed for the rest of the period. So that'll be a discussion to have with your, again, auditor early to proactively plan for that.
Thanks, Nicole. So if you do have any follow-up questions, we encourage you to email marketing@rlb.ca, and I'll be sure to forward them on to Nicole and Eric. You can also contact your specific accountant if you have any specific questions. In the follow-up email we'll be sending, it has a feedback survey. If you wouldn't mind taking 2 minutes to fill it out, we greatly appreciate your feedback and are always looking for ways to improve the services we offer. Thank you again so much for attending today, and have yourselves a wonderful day.
Thank you, everybody.
Thank you.